Everyone is chasing the next big thing, the latest technology, the newest IPO, the coolest new startup, the trending crypto. But the secret of long term wealth isn't in a video like this or in an AI based financial advice, it is in a 2,000-year-old book. Hi, everyone. Today I'm going to introduce you to this concept called the Lindy Effect. This can have a phenomenal impact on your portfolio as well as preserving your long-term capital. Simply put, Lindy effect is that the duration or life's future lifespan of an idea, a habit, or a culture is directly proportional to its past lifespan. So, if, for example, a book has been popular for the last 40 years or 50 years, the chances are quite high that it will be remaining popular for another 40 to 50 years. If there has been an idea or a habit that the humans have thrived on for the last 4 or 5 centuries, the likelihood is very high that we will continue thriving on this idea or a habit for the next 4 or 5 centuries. This Lindy effect was popularized by an author or a mathematician called Nassim Taleb. He's written some phenomenal books, The Black Swan, The Skin in the Game, and he popularized this Lindy effect in the book called Antifragile, where he looks at certain things where he says that these are fragile because they are perishable or they have a lot of external disruption onto that, including us humans, that we are perishable, we have a lifespan, while there are certain things that are anti-fragile, that they age in reverse, that they continue becoming remaining, their lifespan continues remaining whatever has been their past lifespan has been. And this has been used for business models, for various things. And we will, in this video, try and use this to see how we can make our portfolio, our wealth, a lot more robust. Because keep in mind that our goal of FIRE is not to retire early, it is to stay retired. And to do that, we need to have certain amount of survivorship bias, that we look at things that have thrived and that will continue to thrive rather than chase the next big thing. I think Jeff Bezos put this very eloquently in one of the interviews.
I very frequently get the question, what's going to change in the next 10 years? And that is an interesting question. It's a very common one. I almost never get the question, what's not going to change in the next 10 years? And I submit to you that that second question is actually the more important of the two, because you can build a business strategy around the things that are stable in time.
So like Jeff Bezos says that, let's look at things that have been thriving. So that's what we're going to do. And for this video, we are going to try and put the investment assets into two buckets: the bucket of fragility, or the investments that we think that are fragile, and of anti-fragile, or the Lindy assets, as I would call it. And similarly, we will do that for our habits. What are the fragile habits and what are the anti-fragile habits? And what can you do about it to make sure that you use this while evaluating or, on your journey to financial independence. So let's start first with the investment assets, and let's look at those two fragile and anti-fragile buckets with three categories. The first being equities, the second being commodities, and the third being real estate. So when it comes to equities, I would say that individual stocks are fragile. And the reason is because the companies behind those individual stocks, they have fragility, or they have the threat of technological disruption, mergers, acquisitions, regulatory changes, business model changing, the leadership dependent on certain individuals in the leadership, or even fraud for that matter. And there are lots of those stories over last few decades that we know, including companies like Kingfisher, Satyam Computers, Jet Airways, and I would even say Nokia, that people who are of my generation, they will know that when we started our journey with mobile phones, and it was with Nokia, that we had never in our lifetime at that time imagined that Nokia one day would get so dramatically disrupted with companies like Apple and Samsung, etc. So individual stocks have this fragility of these external threats that creates a certain amount of lifespan. And interestingly, if you look at the past data, you will see that these individual stocks, even those big companies, generally they are as part of a S&P 500 or an index for just a few decades, and then they generally get kicked out. And talking about those indexes, that's what I would put in the anti-fragile bucket, because indexes, like those stock markets, have existed for decades, if not centuries so far. So whatever has been the lifespan of the stock markets, similarly has been the lifespan of these indexes. And interestingly, the indexes are a lot less fragile because they are much more diversified in terms of industries and so many business models that they are a really melting pot of that diversity of different thoughts and business models. They actually thrive on volatility because if there is a particular industry or a company that is getting disrupted and their business model is failing, they generally are out of those indexes or S&P 500s or Nifties or Sensex of the world, and another new company or a new business model enters into these companies. So you have a lot more robustness there. So the typical action is that, like we are doing, is that try your best to move out of those individual stocks and move into these indexes. These individual stocks can make you rich, or they could be overnight rich, like Nvidia's of the world, but these indexes is what will make you resilient for a long term. Looking at commodities, I would look at two. One is the crypto, and then there is the gold. Crypto, at the moment, I would put it in the fragile bucket. And I'm saying at the moment because we don't know about the future. It could be in another 30, 40, 50 years as part of the anti-fragile bucket. But so far, crypto's lifespan has been only the last maybe 15 odd years. So just by Lindy effect or by that concept means that it'll probably sustain itself for another 15 years at least, but we don't know how long further. The other reason I put this into the fragile bucket is because the crypto has still the threat of regulatory environment, the threat of technology disruptions, etc. On the other hand, gold has survived for thousands of years. It has seen all kinds of regimes where it has seen kingdoms, it has seen empires, it has seen Roman, Greek Empire, etc. It has seen dictatorship, it has seen socialism, communism, democracy. It has also seen all kinds of highs and lows when it comes to the stock market crashes, all kinds of black swan events, and it is still thrived. And unlike crypto, where it is a concept or an idea existing in a technology somewhere, this is something that you can touch and feel, that doesn't get rusted, doesn't erode in terms of the physical asset over time. If you put it in your locker, you will still find it exactly like it is after thousands of years. So this is definitely worth having within the portfolio for a certain percentage. Even if you look at its growth for the last 5 years, it's doubled its value. Over the last 50 years, it has beaten inflation. It has shown an 8 to 12% of a growth year on year, depending on which currency you calculate that growth over a 50-year period. Coming to real estate, I would put land into that Lindy asset or the anti-fragile asset, because like gold, land has been there since beginning of time, and it will continue. Even if we as humans perish away, land will continue. The other thing is that it has also seen all kinds of business models, economic downturns, upswings, different kind of regimes, and it continues to be there. And generally speaking, you still get the same value, and if not maybe even bigger value over a period of time. So it has also shown a good growth. On the other hand, I would put an apartment as a fragile asset because it has a lot of fragility. It has a fragility because of environment issues, calamities in terms of earthquakes, natural disasters, just the regular wear and tear of the building itself. Also, it has the fragility because of the fact that it has a certain lifespan of the building itself, generally probably 50, 60, maybe even 70 years at max. before the building needs refurbishment, etc., etc. It has also the fragility of regulatory or even economic environment, when there is certain times when there has been places in US, in Europe, even in India, when there has been too much of supply and the demand is low, that the prices crash. So if given an opportunity, you should try and own a piece of land versus owning a piece of air, as I would put it, as an apartment. But it is also worth evaluating as a different topic, that should you even own or buy or even rent, depending on the economic situation. Something that we've addressed in a different video, but just here the concept is just to check if it is fragile versus the non or anti-fragile. So these are some of the assets that are worth evaluating in your portfolio and seeing that how much of the fragile assets do you own versus anti-fragile assets do you own. Because keep in mind, and once again to remind, like us, if you have the ambition of being or staying retired, you would have to have a duration of 40, 50 years to plan for staying retired and making sure your portfolio remains resilient for that duration. Now, coming to the investment habits. In the fragility bucket of those investment habits or ideas, I would put even videos like this that you are watching right now, an AI advice or podcasts, or any financial information that you get around FIRE, because all this has been relatively new, anywhere between 5 to the last 10 years or 15 years. This whole FIRE as a philosophy, as a concept, and these podcasts or videos or even the AI advice has just been probably just maybe 1 or 2 years old. So you don't want to just depend your ideas, your thoughts just on these fragile things, including like us. What you would want to do instead is have anti-fragile habits and investment ideas, or that investment culture in you that has stood the test of time for thousands of years. Things that our parents have told us, our grandparents have told our parents, and so on and so forth. So it's something that has been passed on from ancestors. Things like that you save more than you spend. Things like that you live below your means. Things like that you minimize your debt, and that you save or invest for long term. So these philosophies have been there for hundreds of years, and I don't think those ideas or those habits will go away even the next 100 years. So make sure that you are basing your portfolio on these, and you're also getting the best out of these AI financial advisors or YouTube advisors or videos like this. Now, what can you do, and how do you make sure that you are using Lindy to your advantage? So there are certain things that you can do. First is that you have your Lindy filter. And that Lindy filter is that whatever is in your investment portfolio, or whatever is your investment idea or habit, ask yourself, how has this stood the test of time? And if what you ask yourself, the answer is that it has stood the test of time for the last 5 years, you need to question yourself that, is this something that should be part of your investment portfolio, or does this also belong to your investment habit? So for example, there is a lot of debate about this 4% rule, 5% rule, 3%. Some people say that you should follow 5% as a withdrawal rate. Ask yourself on that how has this stood the test of time, and how has it and stood the test of time exactly with your kind of situation. Not if Bill Bengen did a study in the US and it has stood the test of time in the US, it may not be pertaining to you. So that's something that you have to question yourself for both the assets as well as ideas. The second is to read, and not just the new books or watch just the new videos like this, but some really old philosophies in books. So there is an amazing book called The Richest Man in Babylon. This is a book written in the 1920s. And it is, interestingly, though it is written in the 1920s, it is about the 4,000-year-old culture of Babylon. And it is about the financial habits and the culture that they had 4,000 years back. And when you will read it, you will realize that it is still relevant today, those ideas. So don't just imbibe or absorb the ideas from the new set of financial gurus and authors. One of our favorite, which we always say in our videos, is Morgan Housel, The Psychology of Money. They will give you a lot of amazing insights, but also make sure that you get your habits from these really old books, including, I would say, to a point, our own Vedic traditions. I even made a video about this and equate how, interestingly, during the Vedas, they cracked the code of fire and they talked about it thousands of years back, what we are trying to do now. So, in summary, lean on what has lasted for decades or centuries and stood the test of time. Yes, it may not make you as wealthy as some of the quick, rich assets, like even Nvidia stock or a crypto that can make you much richer. But what it will do is make you much, much more resilient and robust for withstanding the test of long term of retirement that you'll have to go through. Because once again, I would say that your goal is not to just retire early, your goal is to stay retired and stay financially independent. So I hope that this Lindy effect gives you some new idea and some new inspiration, as well as a new check towards your portfolio, and it helps you to just do this validation for robustness. Would love to hear your thoughts, your feedback. If there are things that you think pass that Lindy test towards being that Lindy asset or a Lindy habit, and what do you think are those fragile habits or fragile investment assets that you think that I've not addressed in this video. So till the next topic, till the next video, and till the next location, goodbye from me. Bye bye.